Good morning, good afternoon, and good evening, listeners, wherever you are. We are here to talk about the promise of the Indian asset backed securitization market. I am Vineet. I run a group called Vivriti, based out of India, a group that today has been set up to solve for the problems that the enterprise debt market in India is facing. We run CredAvenue, one of the largest global platforms for enterprise debt, a digital platform that brings together thousands of enterprises to hundreds of investors both in India and internationally. We also run Vivriti Asset Management, one of the fastest growing asset managers in India that is building solutions for global investors to participate in the Indian performing credit market. I'm joined today by Vibhor. I will request Vibhor to introduce himself, and then we will dive into the topic for the day.
Thanks, Vineet. My name is Vibhor Mittal. I am the Chief Product Officer at CredAvenue. I'm responsible for structuring and execution of all ABS transactions that we do on our platform, including innovation, introducing new structures and products to the market.
The Indian securitization market has now crossed 30 years of existence. The first trade was done by Citi way back in 1991, exactly 30 years ago. Since then, we've come a long way, right? Now, the market has been roughly divided into two phases. The first phase was the first 15 years between 1991 to 2006, which was largely an unregulated market. From 2006, the Reserve Bank of India put out very clear guidelines on securitization that have been refined from time to time, and that led to an explosion in the market over this period of time. The market is today divided into two broad kinds of products. Securitization debt instruments that get issued to capital markets through instruments called pass-through securities, and bilateral assignments that happen between an originator and an investor. Our focus during the course of our discussion will be on the former, pass-through certificates issued by securitization trusts to capital market investors. This is a space where we have seen the maximum innovation. We have seen multi-originator securitizations, we've seen replenishment-based securitizations, we have seen securitizations of a wide variety of assets, including leases, loans, and many, many more. Let's dive in. The market today in India is roughly an annualized $26 billion market, right? Yes, it has fallen in recent times on account of the pandemic, but the trend was quite positive over the last 7 to 8 years. But is this large enough? When we look at any metric, be it size, scale, growth, as well as proportion to GDP, India still lags far behind. India not only lags behind the US, which is a $500 billion market, India lags behind China, which is an $88 billion market, and India lags even behind South Korea. India is still at sub 1%, and therefore has a significant way to go versus many, many other economies which are between 2.5% to 5% of GDP. Having said that, the Indian market today has been characterized by significant diversity. Unlike other markets which might be dominated by mortgage and auto, the Indian market is very diverse, ranging from unsecured assets to secured assets to mortgage assets to auto to commercial to consumer to microfinance, and therefore represents a fairly diverse opportunity for investors that are seeking to build an asset book in this space. The Indian market has grown well. As I mentioned, there has been a dip in recent times on account of COVID, but notwithstanding that, there has been a steady rise in both issuances and issuers over a fairly sustained period of time, with the real inflection point happening when RBI formalized regulations for this space. Having said that, there is definitely a very, very long way to go. This market can become much, much, much larger from there on. Now, what is the mix in terms of issuances by way of ratings, right? For the longest time, in my memory, until 2010, the market was dominated by AAA transactions. In recent times, a very welcome extent of depth has built in the market, with transactions in AAs and single A's starting to build up and become a larger and larger share of the market. Today, 2/3 of the market continues to be AAA, but the balance 1/3 is now in the rating range of AA and single A, which is signifying that the market has deepened and there is more acceptance of the product. I'm going to now hand over to my colleague Vibhor, who is the Chief Product Officer at CredAvenue, to tell us a little more about the risk-reward of securitizations and what does it really show for investors over a sustained period of time. Vibhor, over to you.
Thanks, Vineet. So if you look at the performance of domestic transactions in the Indian market, the performance has been fairly steady and good across all rating categories. If you look at AAA rating, less than 1.5% or thereabout transactions have been, downgraded over a 1-year period. So even if you look at performance in rating categories AA and A on a domestic rating scale, the performance has been reasonably good. If one was to compare and contrast the performance of Indian ABS transactions vis-a-vis global ABS transactions, mind you that India is rated in BBB category on a sovereign scale. So when we are contrasting the performance, one should look at AAA transactions rated on the domestic scale vis-a-vis BBB category transactions on the international scale. And there, if one looks at the performance, one sees that the performance of domestic transactions has been far better. So if you see, the extent of downgrades that have happened for BBB category global transactions on an international rating scale, the number would be upwards of 8%, whereas the comparable number even for AAA transactions domestically is 1.5%. So that demonstrates that the domestic transactions have been fairly resilient in terms of performance and have far outweighed performance of global benchmarks. In terms of pricing, there is a dichotomy in the pricing. So what one sees is that the spreads for ABS transactions are at a premium vis-a-vis the corresponding spreads on the corporate bonds, which means that there is a premium that the investors are asking for ABS transactions. That's largely to kind of reflect the structuring which is involved in the transaction and possibly slightly higher perceived liquidity in these set of transactions compared to corporate bonds. If one looks at how the performance has been through the pandemic, even here the domestic transactions have performed well across all rating categories. So if one looks at the extent of downgrades, one sees that only 5 transactions across 2 entities have been downgraded during this period. If you were to keep aside maybe 2-3 entities which are already under stress prior to the pandemic. So the performance is not on account of, if at all some transactions have been downgraded, it's not on account of the pandemic. On the other hand, if you look at the number of upgrades, there are 41 transactions that have been upgraded, and that's across 20 originators. So upgrades have far outperformed downgrades, and the credit ratios appear very, very favorable on that count as well. There have also been incidences of servicing being taken over by alternate servicers. So while there is no concept of an upfront servicer being appointed as a backup in these transactions, but at the same time, if an servicer has gone bankrupt, there have been incidences where some other servicer has stepped in and taken over the collections, and the performance of these set of transactions continues to remain strong. Now I'll hand it over to my colleague Vineet to emphasize on what are the challenges that is kind of constraining the market from an offshore investor point of view.
Thanks, Vibhor. So while the market has, as Vibhor mentioned, evolved very, very well and matured over the last 15 odd years, we are still seeing a lot of questions and hesitancy from international investors. We would have seen a handful, perhaps a single-digit number of transactions where global investors participated. Some of them were linked to stress situations, some of them were linked to the mortgage space. But why haven't international investors participated more? The answers we hear are common across a host of investors. Taxation is adverse. Withholding tax for securitized debt instruments continues to be very high, depending on the domicile from which you're investing from. There is a lack of a very good quality digital infrastructure that can bring together and create a common repository of information on credit information, on asset information, performance data across transactions. Transaction execution is also a problem. Stamp duty that keeps getting incurred when a mortgage is being transferred from the originator to the special purpose vehicle continues to be a problem, and also varying across the country, resulting in lack of clarity, right? And finally, the entire issue of the exchange rate, right? The exchange rate depreciation has been an issue of worry for investors, especially because cash flows of a securitization trust are not entirely predictable, and therefore having a very, very clear hedging strategy often proves to be difficult for international investors. Having said that, things are looking up. When we look at the exchange rate performance of India over the last 15-20 years, while hedging cost remains relatively high. A 5-year hedge cost today remains anywhere between 4.5% to 5%. But when you look at the actual depreciation of the Indian rupee versus the dollar, those numbers have been much more stable over the last 5 years and the 5 years before that, which gives an indication that the markets are pricing in a much higher extent of risk than actually exists. Now, why has the currency been stable? It is no secret that the Reserve Bank of India over the last several years has done a fantastic job in building a buffer of foreign exchange reserves. This number is close to $600 billion today, and it's a significant war chest that allows the Reserve Bank of India to maintain a low volatility of the exchange rate. In addition to this, there have been several other developments as well. The foreign portfolio investor route, something that Vibhor alluded to as well, has opened up for international investors. Taxation remains a problem, but the regulatory regime for international investors to invest through the FPI route today has smoothened, and hopefully taxation will follow. But in more recent times, something more exciting has happened. The Indian government has set up an international financial center in the gift city close in Gujarat in India to bring in a significant amount of global capital into India through this route. The gift city today offers a way for us to solve for many of the issues that I outlined earlier around the exchange rate, around taxation, around uncertainty of cash flows, by building in pooling mechanisms using alternate investment funds set up in the gift city. These funds could be set up to invest into securitized paper, pool these together to have better diversification, lower risk, and better cash flow management, enter into common hedging agreements to be able to give more clarity on post-hedge dollar returns, as well as significantly reduce the taxation burden, given that there is a favorable taxation regime today that exists between the GIFT City and India. These are significant positives. To our mind, this will form a very welcome window for global investors to invest in debt markets. Having said that, the Indian market is complex. Right? It requires, global investors will require a lot of assistance from platforms that exist in India to be able to take significant exposure and build comfort and scale in the Indian ABS market. Let's hear from Vibhor how CredAvenue proposes to address this challenge.
So in the last 4 years since inception, we've done more than 350 ABS transactions with cumulative issuance volumes in excess of $3 billion US. The performance of these transactions has been remarkably good. So more than 50% of the debt has already been paid back to the investors, and the cumulative losses that have happened are next to negligible. In terms of the portfolio that we manage, the volumes are in excess of $7 billion. So every month we are getting contract level granular data in respect of over 6 million contracts, which is then feeding into our proprietary models, which help us estimate how the performance would be, and also sharpen our analytical tools, which we are then providing to investors to evaluate the underlying transactions. As a group, in terms of coverage, we cover more than 350 entities in the financial services space across all categories of asset classes, right from microfinance to gold finance to commercial vehicles, mortgage, both home loans, home equity loans, consumer loans including personal loans, consumer durable loans, and so on. In terms of our risk management capabilities, so we've had banks like SBI, Federal Bank, as well as Indian Bank. They've put transaction volumes of more than $4 billion on the platform for us to kind of monitor the performance, and also help them with customized dashboards which help the teams evaluate how the pools are performing, and also benchmark them against their other investments, as well as the peers which are there in the industry, as well as overall industry level numbers. What the platform today solves for, so there is obviously discovery which is happening on the platform. Pricing is available in a very transparent manner for all investors to see. Is also able to do a lot of credit diligence both on the entity as well as on the underlying set of transactions that are being evaluated. We also put out a detailed commentary on the entity, as well as a loss estimate on the pool, as well as expected performance over the life of the transaction. Beyond price discovery, the platform also solves for fulfillment and portfolio management capabilities, something which I had anyway covered earlier as well. So CredAvenue together with VAM can solve for all requirements of offshore investors when they're looking to deploy capital in India, especially for ABS instruments. So while CredAvenue, the technology platform of the group, can solve for discovery, diligence, execution needs, even post-transaction support around portfolio management and risk management. The asset management company can provide for the SPV vehicle through which the funds can be deployed in a more tax efficient manner, as well as take care of their currency hedging requirements and also solving for their post-tax return requirements. So as a group, we can take care of the transaction lifecycle needs for all offshore investors for the entire period of their investment.
Thanks, Vibhor. So in a nutshell, summarizing for the benefit of our listeners, the Indian securitization market is representing a very large opportunity, growing rapidly, and has a long way to grow from here. It's a market that has demonstrated very good performance, far outstripping global markets on comparable rating scales, on asset performance, on rating upgrades, as well as the kind of granularity that you see in this market. It's a mature market. We have seen 30 years of history, and therefore there's a lot of data that is backing the performance. Investors have held back for a long time on account of regulation, on account of tax, on account of servicer risk, on account of bankruptcy risk. But today we think that the market has reached a position where these concerns have become much lesser than what they were even a year or two ago. And it's therefore a great time for international investors to assess this market at a much deeper level. We at CredAvenue and Vivriti Asset Management have the solutions that are needed for you to do this. We have the technology, we have the risk management, we have data, we have history, we have structuring, we have products, and therefore we are well placed to manage this flow of capital from international markets into the Indian securitization market. Look forward to working with you guys.